What's up, investors? Sneers here. The tech industry has been in a downturn since the beginning of the year, and especially high growth subscription based companies that is not yet profitable. Now, some of the downturn can be easily explained by having a massive bubble in 2021, and some of it is obviously that, but it's more than that, and it's about how the model is broken, and that's what the video is about today. Let's look, for example, at the company MongoDB, which at the peak of 2021 was almost $600, and today they are close to $200, more than 60% downturn. Now, if we look at the revenues at the same year for MongoDB, you can see that at 21 they had 171 million as revenue, and if we go all the way to today, it's 300. They almost doubled their revenue. Their growth has been accelerating. Year over year, it was 38, 39% when we talk about 2021. And when we talk about 2022, it accelerated to over 50%. Yet they have this massive downturn. We can look at another example. We have DocuSign. Again, more than 60% downturn, and their revenue has been growing very steadily through this time, from 430 at 2021 all the way to 620 at the last quarter of 2022. Their growth has been slowing, but we have so many other examples. We can look at HashiCorp. Again, HashiCorp, their stock is down massively, more than 60%, but their revenue has been accelerating and their growth has been accelerating. So why, even though these companies are growing and growing fast, and technically it looks like they are not slowing from 2021, why is the downturn so massive? And before we continue, I want to mention that this video is based on a newsletter post that I have for my newsletter subscribers, which is completely free, by the way. You can see it now on the screen. And I recommend reading it. You will find a link in the description if you prefer reading, and it has some more complementary data and links for more details. With that said, let's continue with the video. To understand why these companies, these tech companies that are based on subscription, are going down so fast, we need to understand some subscription-based companies terms, talking about CAC, which is the customer acquisition cost, and lifetime value, LTV. The customer acquisition cost is how much it costs to get a customer in to start paying. It's the costs of the marketing, sales, and whatever is involved in getting this customer in. And the lifetime value is how much the average customer from the same cohort, the same period we got the customer we calculated the CAC for, how much he will spend throughout his lifetime with the product. Let's say he pays $10 a month and he stays on average for 3 years, that's 36 months, so the lifetime value is $360. Now, there are many more details about lifetime value and CAC and all the things and how they work together, but this is not this video. I just want to get the basics. If you want to expand, there are many other articles and videos, and I will leave some links in the description. But the important thing to know here is that the profit for subscription-based companies is always delayed, because maybe the CAC is, for example, $300, even though the lifetime value is $360, I won't see the profit until 13 months later. And that causes these kind of companies to look like they lose money all the time, which they are, MongoDB and many other such companies. And that's because on paper they lose money on the GAAP terms and what have you, but if you look at the unit economics, they may be profitable on paper. They just prefer to spend every dollar they get into marketing, into sales, to get more customers, because their calculation of the CAC to LTV shows that it's profitable in the long term. You just need to wait 13 months to see the profit of the customers you brought back then. It's something to be noted when you look at companies that do subscription based, as compared to companies that sell products and you know immediately the cost of creating this product and what it was sold for. it's either profitable or not immediately. Now that we understand that the profit is delayed for such companies, we have two things to consider when we look at the model for profitability for such companies, which is inflation and the cost of money. First, let's talk about inflation. Inflation was strong in 2021, even before they dropped. If we look at this graph of the Nasdaq, just to represent what happened to most stocks there and most of the unprofitable SaaS companies. So here in October, inflation was already 6.2% and accelerating. It was 5% the month before that, and lower and lower. So it was accelerating well into the highs of the Nasdaq. So inflation alone didn't do anything. Only when the Fed announced that they will raise rates, that's the point where the stocks prices got down. So inflation alone wasn't reason enough for the stocks to go down. You needed rates as well. The reason for that is the cost of money. Because up until the rates got higher than effectively zero, money was free for everyone, especially for big investors that could leverage themselves for essentially for free. And those kind of investors were the one who invested in startups and in high growth tech companies and things like that. And once the money is free, it doesn't matter what the inflation status is, as long as the model is working. And what do I mean by that? So let's look together at this graph. We can see the customer acquisition cost here for $100. And we look at an example for lifetime value, as most customers in every cohort will leave through the years. So the revenue every year is a bit lower. But in the first year, we make $50, then $80, then $100. That's when we break even at the start of the third year. And then it's all profit from here. But now let's consider the cost of money. Let's say that with the rates and with people deleveraging and everything, the cost of money is 6% plus or minus for investing in such equities. So the CAC is no longer $100, but it's actually a bit higher, $106. And that already moves the model from break even at the start of the third year to closer to the end of the year. And once you have cost for money, the time element is essential again, because you can't just pour more money into the model, as money has some cost. And once money has cost, it has value over time and devalue over time. Before the rates hike, it didn't matter what happened through time to the value of money in these models, as long as you made more money, because you can always pour more money into this thing. It reflects in many other weird models of investing. For example, when you try to apply 0% risk-free rate for DCF analysis, it means that you should buy everything. So that's essentially the same from a different perspective. When the rates were zero and money was free, inflation had no effect. That's why the stocks didn't go down as inflation got higher, only when rates got higher and money had some cost. Now let's look at the model of what happens when we apply inflation. You have here the real lifetime value when we apply inflation. So let's hide the lifetime value that isn't real, and let's hide the CAC that is without the real cost. And you can see, just by applying 8% inflation and 6% cost of money, the model that was before very profitable within 5 years is suddenly only break even, merely break even. It's actually losing money. And if we raise the cost of money a bit more, you can already see that it's losing a lot of money. Or for example, if we get higher inflation, let's say 10%, let's be realistic here. So it's losing money. That's why these kind of companies got drawn down on the price of the stock so fast, because suddenly it's not a model that just prints money out of thin air and they can just raise more money either in bonds market or from other investors, and get more shares out, sell more shares, because the prices of the shares are obviously in a bubble, so they get free money from other investors. That's no longer the case, and so many companies losing a lot of interest. And the problem here is that these subscription companies and their profitability model is very future dependent. And once we take into account inflation, you may say, oh, they should just raise prices. But if they raise prices, the churn rate will be higher. So the lifetime value, as more customers will leave them, will be lower. So maybe raising prices will actually lead to lower revenues. And maybe raising prices will lead to higher customer acquisition costs because less customers will buy into the product with the prices higher. So this one action of having rates higher than zero is disrupting the entire model, and it's risky and unpredictable. And that's exactly what investors hate to see. So even though these companies are growing fast, it means that we can't be certain about the model of profitability. Nobody can really model it accurately, and nobody can know what will be their profitability in the future. So valuing them becomes much harder and much more unpredictable. And that's part of the reason for the drawdown in their stock prices. And that's everything I have for you today. I hope you enjoyed it. Don't forget to subscribe to the newsletter below, and maybe leave a like in the video if you liked my content, and I see you next time. Bye bye.